So the bank is actually watching your equity as much as you do, right? As much as you're watching your equity, you want your equity to grow. The bank is also keeping an eye on that money. They have a position, right, that they're taking on that money. But the difference is you're paying the bank's interest plus the principal. So you're actually losing, that opportunity cost and that money, if that money could have been sitting somewhere else earning money. Okay, this is what most people don't understand, that the bank also wants that equity in your house. That's why a lot of them will educate people to put a large down payment on the house. They're incentivizing you to do that, right? There's a reason for that. And we're going to go over some numbers later on with that. But what is opportunity cost? If you look at my other videos on the website, we've already discussed this, right? Opportunity cost is not just the dollar that you lost, but what that dollar could have earned for you if you put that somewhere on a different account earning money, right? So when you look at opportunity cost and you kind of relate that with your mortgage, when you do you earn interest on your down payment? No, you don't earn money on your equity. If you dump 100,000 in your house, do you earn interest in that? No, the house appreciates, it could go down in value. You don't know what's going to happen. So you don't really you're not earning money on that money, right? Is the down payment money accessible? No, it's not accessible. What do you have to go to? You have to go to the bank, W-2, tax return, pay stubs, right? Good credit, okay? If you have a business, P&L. The bank has all these hurdles that you have to go through in order to access your money. I want you to consider that, right? So what would your down payment be worth today had you been able to invest it? So we're going to look at that. That's your opportunity cost. That's if you were to put that in an account where it's earning money, that's your opportunity. So let's look at that really quick. So let's say I usually like using the entire price of the house because, for most people with their box of knowledge that they have today, if you're, for example, if you go into the mainstream media channels, they're telling people to pay cash for their houses, right? If people can do it, they'll consider it, or they have that money for it, they'll definitely do it. So I like to use that entire amount. How much are houses nowadays? You're looking at 300,000, 400,000, right? So most houses today, on average, is running between 300 to 400,000. Let's say you could put that somewhere where it's earning 6% for you. In 30 years, let's be a little conservative. Let's just say 5%. The money's earning 5%. In 30 years, if that money, that 400,000 was compounding at 5%, it would have been worth $1.3 million. Okay, almost 1.4. So what I'm trying to say here is, in 30 years, if you can't sell that house for $1.4 million, then you lost money. Okay, that's what I'm trying to tell you. Because that's that opportunity cost on 5%. If it was 6%, $2 million. So in 30 years, if you can't sell that house, that $400,000 house that you paid cash for $2 million, you lost money. So that's what I want you to understand. That's your opportunity cost on that money.